Good evening, everyone. The economy seems to be getting its act together. Economic activity this spring and summer is picking up after a brutal winter that caused growth to pretty much come to a standstill. The Commerce Department says the gross domestic product, the broadest measure of economic activity, expanded at a rate of 2.3% in the second quarter. Although the number wasn't as strong as many expected or had hoped, consumer spending, which makes up the majority of economic activity, was strong. But even though the report was slightly below expectations, Steve Leisman tells us why it may be enough to seal the deal for a possible rate hike in September.
The government's saying today there was more growth than it first reported in the first quarter and less growth than the market expected in the second, leading to a bit stronger growth in the first half overall. First quarter GDP revised up to 0.6%. It was originally reported to be negative. The second quarter came in at 2.3% for a decent but unspectacular bounce back. And there was more inflation than initially forecast, something the Federal Reserve has actually been seeking. So many economists say the data is sufficient to seal the deal for September rate hike from the Fed.
I think they want to go. But I think if they do go, they're going to explain to the market very clearly that this is not the beginning of a very consistent rate hike cycle. They're going to be, again, very data dependent.
Lots more data to come before the Fed meets in September, another GDP revision, and a couple of jobs and inflation reports that will ultimately determine if there's a hike.
If we get a strong number next Friday, I think September is looking increasingly likely. I thought the statement we saw yesterday showed the Fed opening the door to September. And all we need to get through that door is two good jobs numbers.
The Bureau of Economic Analysis announced its regular annual revisions of the past 3 years and also a correction to how it seasonally adjusts the data, following a series of CNBC stories raising questions about the GDP reports. The revision meant the big scare in the first quarter of 2014, when it looked like the economy could plunge into recession, was mostly revised away, from a 2.1% decline to a more manageable 0.9% fall. Overall, the government revised down GDP over the 3 years ending in 2014 by a modest 0.3%. But it also took the first steps of changing the way it calculates GDP to account for anomalies in the quarterly pattern of growth, changes that could mean smoother data and less anxiety among investors in the future. For Nightly Business Report, I'm Steve Leisman.